All right. I am starting about 6 minutes early. I'm certain that I'll be joined by some folks fairly soon. And this, of course, is for BISS 1123, Section B. And we're at week 4 here, the week of 226 and 228. And so I anticipate, like I said, I will have some people, I'll have some folks join me here in a few minutes because I am starting early. You will want to scroll back. Those who, I'll encourage them to do that so they can see. We've got a couple of, we have some assignments coming up. I want to talk about those. And then today we're going to start on spreadsheet case 11, which is Morgan Wagner machinery. And we have exam 1, part 1, which is due March 1st, okay, which would be tomorrow. And then I have a sample exam up there for everybody to take a look at, okay. And then we have exam 1, part 2, which is a hands-on part that is also due on the first, which is tomorrow, and then exam 1, part 2 instructions. And I'm going to open this up for a moment and spend just a little bit of time talking about it, okay? All righty, and it should render open for us here pretty quickly. For exam 1, part 2, okay, you're going to use the file from XLSX6, Badger Jams. Now remember that was case 6 in the solve it text, okay, and that was where we did the break-even analysis. You'll remember that. And then what you're going to do is go in and you're going to change some of the expenses in there. For example, the rent, you'll want to increase it by 5.3%. Advertising will need to be increased by 2.9%. The commercial stove, you'll reduce it by 6.8%. The cooking equipment will go up in price in 3.2%, and the shipping will increase plus 12%. Now, what I ask you to do, okay, is to compute the selling price required to keep break-even units at 1,147 units sold. Document your work by uploading an XLS file that documents your work. You could take XLS6 and one that I've posted over said, load this one up and make sure that you have the new selling price entered. Okay? Now, I've had some questions about, well, how could I do this? And of course, we're going to go back to a familiar friend, the what-if analysis, and inside that, we're going to look at using goal seek. Now, I'm going to go over to the files area for just a minute. Let's start with this. And I'm going to look for something we uploaded for case 6. All right, so let me find that. And get the student files. And it's going to be Badger Jams. Here we are. Here's one that was done. Badger Jams. That's XLS6. And I'm going to download it. And then we'll talk about what I'm asking you to do. Okay? So there will be no, no question at all whatsoever. I'm going to enable the editing. Now you're going to see that you have several expenses here, and these are the things that you'll either increase or decrease according to this as well, according to the instructions I gave you. Now, okay, you'll input those, all right, and when you're through, it's going to change these figures, especially what's break even units. All right, and then the bottom line is very simply, I want you to use goal seek to get break even units. and I'll just show you here for a second. Okay. Of course, you know, break even is in the data area. What if analysis? You see the goal sheet. Glad to have you here. And I start a little bit, but all I've asked. Hi there. All I've asked you guys to do is to go in, okay? And what I want you to do is to hang on. I think that's the boss. Hi, sweetie. How you doing?
Hi, did I interrupt?
Yeah, I'm getting ready to do class. I took the dog out for a walk. I was just gonna see how you're feeling. Let me call you back when I get out of here, okay?
Yeah, absolutely.
All right. I love you.
I'm in
Okay.
the meeting with Doug and Donnie.
Oh, you are? Okay.
Well, I don't know when it'll be, so if you don't get me, that's fine.
All right. I love you. Talk to you later. Okay. Bye-bye. Okay, that was the boss, and I had to clear some logistics with her. I apologize. But I had some questions about exam 1, part 2. And so you can scroll back and see what you'll need to do. But basically, I asked you guys to change some of these figures, okay? And just for example, let's say I change rent to $15,000. And notice now what happens is, having changed it to $15,000, notice the break even now is $1,280. All right. So what I've asked you guys to do is to figure out how would I get, say, with that change, if the rent's $15,000 a year, how would I determine the selling price to get to break even? And as I mentioned before, it's in the what if analysis, and I use the goal seek. And so I'm going to set this cell I want to set this cell right here, the break even, to 1147. Okay, so that's my target cell, and that's the target value by changing this cell, the sale price. So what I'm basically doing is I'm saying, okay, if I'm going to have rent that's at $15,000, I want to change it. What selling price do I have to stay at 1,147 break-even units? That's all that's involved in this, and changing some other figures. And I just click OK, and it will tell me that's the sale price that I have to use. So that's exam 2, part 2. I'm not going to do any more because, you know, frankly, it's just putting in the figures I ask everybody to put in. And I'll get some questions like, okay, well, what figures are you talking about? Okay, and I'll go back up here and we'll go and I'll show everybody. Glad to have all of you here today, and we'll go into the syllabus part, because that should give us real quickly what we're after there. And that's going to be the exam 2, part 1. Exam 1, part 2. My apologies. And I'll have to go over to the modules to get that. So let me go up into the modules, and we'll go down here to module 4. Okay, and we have exam 1, part 1. Okay, and there's a sample. Here are the exam 1, part 2 instructions. It's pretty simple. I ask you guys to change some of those figures. So use the file for XLS Badger Jams, and that's over there in the files section. And assume the following changes from the base figures provided in the case. So you're going to change rent advertising according to an increase or decrease per percentage, and then compute the selling price required to keep break-even units at 1,147 units. So, okay, and then I ask you to document your work by uploading the file. All right. So that's exam 1, part 2. I don't think I can do any more than that. use the goal seek, okay, to set the break-even units at 1147, and then you'll want to change the selling price. So you remember in the goal seek you have the target sell, the target value, and then the cell that needs to be changed. That's that third one in the what if analysis. Okay, that's pretty much it as far as exam 2. And exam 1, part 1, I have a sample for you. I think also up in the announcements section, I have a document that tells you where to go get resources for exam 1. Okay, so we're down here. We'll go back to the modules. And we're going to work today, as always, we're working ahead, okay? Things are kind of slow today on the machine, all right? And I'm going to come down here to, let's see, week 4. No, pardon me. Yeah, we're in week 4. And today's the 28th. Whee, that was, and here's the deal. We're going to work on case number 11. Now, you should have already uploaded case number 6. We've done that, and in fact, that was Badger Jam, so you should have already uploaded that. And as I said before, we're working ahead so that when we get to access, if we need to go slower, we can do so. All right? Now, you should always, as I said over and over again, you should have the Solve It 6.0 book with you, and we're going to work on Morgan Wagner Machinery, which is page 103. And here we're going to do a sensitivity analysis using a 2-input data table. Okay? And I will show you what we're going to do. Sensitivity analysis, okay, is a way that we say, okay, if we change variables a certain way, all right, then how does it affect if I change variables and get a different outcome? How sensitive are those variables to that new outcome? In other words, how much do they tend to vary? So sensitivity analysis is one of the ways we do that. And we're going to see this when we compare, we're going to get a profitability index, and we're going to compare interest rates, and I believe it's also going to be on the basis of, we're going to have interest rates, okay, and then the, let's see, the data table, and annual additional incomes. All right. So, and it also let's take a little bit of take a little bit, excuse me, at using at putting together a capital budget. Okay, so this will be a piece that covers capital budgeting and the time value money. And I'm going to go down here and find the student Solve It files, Solve It 6.0 files, the student files. All right, and we're going to download that. Okay. All right, and we're going to come down here and find MWM, and that's Morgan Wagner, and we'll open it up. Okay, and I'm going to save that file on my desktop. Okay, and I'm going to save it as I'm going to save this as case XLSX case 11. And I'll put Harmon Keith. And I'm going to save it to my desktop. Now, you may have to invoke. I'm not sure if you're going to have to do an add-on with Excel or not. I don't believe you'll have to, because we're going to use the NPV. Now let's talk about this for just a minute, and before we do anything, let's talk about the structure of the spreadsheet. I always try to emphasize that. Here's the title. That's the first part. Then we have the documentation, okay? And then you'll see we have an assumptions area, all right? And then we have an input and computational area. And then we illustrate it using the two variable data table. Okay? Now, as usual, at the end of each case, the authors will show you or will give you a tutorial, and they have a couple of things they want us to do: the edit fill series command, and then a data using the data table command. All right, and we're going to work on that. And here we have a situation where we have this company, and they talk about it here on page 103, that they're going to buy a new computer numerically controlled machine, a CNC tool. This is a computer that controls how a tool operates. It might be something that drills. It might be something that screws on a nut. Who knows? But they're in the machining business, and so they want to buy a new piece of equipment that's computer controlled, and thus it's programmable. So and I'm on page 103, and they say, okay, they believe, this is the first paragraph in 103, if they buy this piece of equipment, okay, that they're gonna get an after-tax income of $130,000 a year over 5 years, because it's gonna reduce their production costs. Okay, and then they hope to sell that thing at the end of 5 years for what we call a salvage value, okay, and you get $210,000 for it. Okay, anytime we buy something that we'll use for more than a year, it's called a long-term or a fixed expense. And when we design a budget for those kinds of things, it's called a capital budget. And so we're going to do a little bit of capital budgeting here, okay? Now, at the bottom of page 103, they talk about the concept of the net present value of money. Okay, in the simplest way it's very intuitive and easy for us to say, okay, if I have $100 in the bank and I earn 10% interest, I'll have $110 at the end of year one. If I keep it for 2 years, I'll have $110 times 1.1, which I think it ends up giving me, I think it's $121 or something like that. But the basic idea is I'm compounding that interest. There's also a process known as discounting, and that discounting says a dollar will buy me a certain basket, if you will, of goods and services today, but it won't buy me the same amount tomorrow because of inflation. Okay? And inflation is caused by any one of a number of factors, including you, me, and all of us that want a pay raise every year. Okay? So we discount or we find the net present value. We want to know what will that money that I'm going to get in the future buy me today. Okay? And I'll give you a good example. The second house that my parents built in Del City, okay, that's where I grew up. It was a very different place. We were out in the boonies. It wasn't at all like it is now. Their house was $12,000. Okay, now I think the median price for house today is $250,000, and my parents had a nice house for that time. We were the first people in our block who had an attic fan. You don't even, probably none of you know what that in the world that is. What it does is it's a huge fan, okay, and it just pulls air, and what it would do is it'll put a hot air out of the house, okay, and the house will cool down, okay, and they have them now, and then I think we also had air conditioning units. A unit was, you put this air conditioner into the window, and then they had a big thing in the living room called a swamp cooler, which had water there, and the cooler would pull that water and it'd cool it and blow it. So our house is air conditioned. We had a furnace, that you could control with a knob, as opposed to how they used to be, was you had a key, and people burned themselves on the grates and the furnace and all that stuff. So, and 12 grand won't get you anywhere. Okay. And I can tell you that when I was your age, I thought that when I make $50,000 a year, hey, I'm going to be swimming on easy street. $50,000 a year is a median income in Oklahoma for a family. I think it's 45 or 50,000. So money loses its purchasing power over time. So we have to take that into account when we say, okay, how much will I get over a certain period of years? So I'm on page 103, and so they say, okay, we have an initial investment period, okay, and we're going to do that. That's also known as the sunk cost. You remember when we did Badger Jams, and that business owner there had to put up the money for the rent, for their equipment, advertising. We called it a sunk cost. Those are costs that you have to absorb, okay, before you ever do a lick of business. So in the text, they're telling us here, okay, we're going to use net present value, and then we're going to compute a profitability index, okay, and we're going to evaluate this. And at the bottom of page 103, they talk about the fact that a dollar earned 10 years from now will not be worth one of today's dollars. Okay, so at the top of page 104, they talk some more about interest rates, compounding, etc. Okay, and then we come down to the bottom of page 104 and the top of page 105, and they give us a series of tasks to perform. Okay, and it says, first of all, review the problem, okay, and take a look at the assumption. Here are our assumptions rate. The interest rate is 10%. The salvage rate of that piece of equipment is $210,000. That's what we'll get for it. And because we buy it and it increases our productivity, we make an extra $130,000 a year from it. Okay. Well, we've got to start with that. Okay. And we're going to come down here, and we're going to look at the income from the investment. And that's the annual income. And we're going to do, in order for this data table to work, we've got to do some chaining with the cells. Watch what I'm going to do. I'm going to put equal, okay, and a salvage value. All right. And I'm just simply going to use absolute cell reference. So I'll highlight those and press F4. And then I'm just simply going to carry it on across. All right, because they're going to make 130,000. I did the wrong one there. I need to make that B12. I'm sorry. It's $130,000 a year investment. The salvage value is the 210. My apologies. All right, there we go. Now the salvage value of the investment, that is going to equal 210,000. So we'll put this up here. And I'll go ahead and make that. Now we say, okay, what's our annual net cash? What's our annual net cash flow? Okay. Well, the annual net cash flow per year, and it's going to equal. And notice I'm going to do B18. I put a dollar sign. Pardon me. Let me go back over here. We want to put the dollar sign in front of the row. Okay, and then we're just going to come across, and the annual net cash flow for up to here will be, yeah. I'm not comfortable how I'm doing it. Let me go back here. I don't want to do that. Let's get rid of that. I'm going to use this equal the sum and then I'm just going to carry it all the way over here. All right. All right. Now the total cash flow, okay, for those years is going to equal the sum of these, and I think it comes like the $990,000. Yeah. Okay. And now we want to do the net present value. Now we're going to use an Excel function for this, although we could do it by hand, and it's not really the best. Now I want to say something about this example here. It's fairly simplistic, and it's not realistic in the sense that cash flows from a project are never even. They're uneven, and there's a function in Excel called XNPV, which is designed to deal with those fluctuations. The NPV function itself, okay, is really designed to give us it's designed for us to use it like as if we're dealing with an annuity, which is a fixed amount of payments for a fixed amount of time. Okay, so we've got these we have these cash flows, the additional income. We have the salvage value of the investment, which is $210,000. That's at the end, and we have the total cash flow for 6 years. Okay, and now we have to use the NPV command. All right, and we're going to do that. And in this, we're going to use that function. All right, and we're right here, and we're going to put equal NPV parenthesis, and notice we can work with the dialog box. Now we're going to find the rate, and that's the interest rate. There it is in B10. Okay, and then the value. Okay, we'll click on that, and that's the values that we have. And we're just going to come over here, and we're going to get these annual cash flows. Okay, and we get this answer, 684,723. Now the net present value of that investment is going to equal the present value of those cash flows, and this will equal the present value of the cash flows, okay, minus the cost of the investment. And there we are. Okay, now they talk about this in the textbook. Okay, and we get the net present value of the investment by subtracting the cost of the investment from the present value. Okay, now that's how we get, pardon me, that's how we're going to, and I'm going to start on step number 2. We're going to use the NPV box, which we did. Okay, and then we're going to get the present value, which we use the NPV function. So we had the total cash flow, we summed those. We got the present value, okay, and it says you don't need to put the data, but calculate the net and subtracting the cost of the investment from the present value. Okay, so we have the present value, and we take the cost of the investment. That was the $640,000 to buy the machine, and we're here. Now they want us to compute the profitability index. Okay, and we calculate the profitability index. Okay, and they're going to walk us through that process there. Is budget, and we take it. It's the profitability of different potential investments. Okay, and we take the present value, the cash flow. Okay, the initial cost versus the initial cost of that. So we're going to compute that profitability index. All right, and so again on number 2, they kind of jumble this up. So listen carefully, and this is in your text. At the end of step 2, we calculate the net present value. Okay, we do that, and then as they walk down there, the profitability index is the present value over the cost of the investment. Now, let's think about the logic of that for just a moment. We spent $640,000, okay, to make $684,000, which in today's money, remember, because we're going all the way out there for 6 years at 10% interest, in today's money is $44,723. So the profitability index, it's going to equal, okay, the net present value, that's B26, divided by the cost of the investment, and there we are. Now, the authors ask us, okay, to round these down, and so we're going to do that. And we'll take it out to three places. But again, to get the PI, we take the present value, okay, and we divide it by the cost of the investment. I took the net present value, so I messed this up. So I'm going to do this, equals the present value, pardon me, divided by the cost of the investment. There we are. All right. So it would be 106.99. I apologize. I took the net present value. I needed to take the present value. Okay. Let's review real quickly about where we got these figures, and then we'll move on down to the data table. First of all, we had this interest rate. This is also known as the capital hurdle rate or the discount rate. This is based on the idea of this, okay? If I have this $640,000 I can invest, if I can make if I can make 11%, or let's say I can make 10.5% in a similar in another investment that has approximately it's the same risk, I'm going to go with that investment. If I've got to earn 10%, then I have to have, I have to make that 10%. That's where I make the investment. It would be foolish for the company to if they could get 10% on this money, as opposed to investing it in the company, they'd be stupid not to just go do that investment, put it in a CD or put it in equities or a portfolio, as opposed to buying this machine. So that's why they call it the capital hurdle rate, okay? Because we always want to make sure that we make as much as the market would given similar risks. And remember, we talked about that risk and reward paradigm. Okay, so here to get the profitability index, all right, we took the present value and we divided it by the cost of the investment. And what that says is for every dollar we spent, we invested, we made 6.99 cents. And you'll remember when I went up here and I took the net present value of the investment and divided by the cost of the investment, I got a 0.0699. Okay, so that's the return in terms of cash flow on this investment. All right, now we're going to work with the data table. And we're going to start right here at the hinge, is what I call it. And I'm going to put equal, okay? Now, they want us to look at this on a series of interest rates. And this is over on page 105. And they want us to look on the x-axis, which in this case is the top, okay, using a series of interest rates starting with 7% and ending in 13% with 0.5% increments, okay? And so I'm going to start this. Okay, now I can do a fill with a series, and I'm going to click fill. I'm over here. I'm going to click series, and I'm going to put the step value, okay, is 0.005 because it's 0.5%, and the stop value will be 0.13, and there we are. I use the series value again, and I'll just back this off to show you what I did. I put this first figure in, equals 0.07, because they want us to go from 7% to 13% with increments of 0.5%. So I come over here to the editing, I click fill, I click series, okay, and the step value will be 0.005 because we're going up 0.5%. They talk about that in page 5. And the stop value is going to be 0.13. And there they are. Those are the interest rates. Now, we have a second piece to this, all right? And on the y-axis, they want us to start with annual income levels. And they want us to start with $100,000. And this is on task 5, page 105, and end with $160,000 with increments of $10,000. So I'm going to put equal, okay, 100,000. Okay, then I'm going to put my cursor right there. That's B34, and I'm going to click fill series, and I'll put the step value is going to be 10000. That's 10,000, and the stop value will be 160,000. I'll click OK. Oops, I messed this up here. I forgot to tell it to go fill series, and I will make sure that I do the column. Excuse me. And so the step value would be 10,000, which would be 10,000, and the stop value will be 160,000. Okay, so we've learned a couple of fill things. Now what we're going to do is we're going to look and see, okay, how the profitability index changes, okay, at given different levels of interest and different annual annual cash flows. All right. So I'm going to go over here, and I'm going to highlight all of this, and I still get a little bit vexed sometimes. I'm equal. And I'm going to use the data table. And I'll put that in. And let's see, the data table command. Oops, I'm sorry, messed this up. The data table, no wonder is having trouble. The data table, I think I highlight all of this. I just don't use it that much. And I'm going to come over here to the data and the what if analysis, and I'm going to do data table, okay? And the row input cell is the row input cell. I'm going to put the row input cell is going to be B10. It's interest, okay? And the column input is going to be B12, which is the income. Now let's run this puppy and see what we get. Okay, now some of these we're going to need to bring them down. Now, one of the ways I check to see if I'm on target is I see, and I'm going to round these. Click home and decrease the decimals out to, well, we'll keep them out there to 4 places. All right. Now, I'm going to back this off, and I'm going to do it in, it can be a little bit tricky. And let me review what we've done at this point, okay? I started off and I put what I call the hinge of the data table, and that equals the profitability index, okay? And I can click up here in the formula bar, I can see that. All right? Everything in this has to be chained using cell references or it won't work. Notice that I always have cell references. This is already in there, so I don't have to mess with it. This is, and then I have my profitability index. Okay. Now I'm going to put the hinge equals B27, which is the profitability index. Then I'm going to say, okay, I want to look at different levels of interest or capital hurdle rates or discount rate, okay, on the value of my money, starting at 7% and going all the way over to 13%, okay, and from 7% going all the way over to 13%, and I'm going to have 0.5% increments. In other words, I'm going to go from 7 to 7.5%, 7.5%, and then 8%, then 8.5%, 9%, 9.5%, etc. All right, and I'm just going to do this again. I've got the hinge, and I'm just going to get. We'll just do this again, and this will be this will equal 0.07, and I'll enter it. Okay, and then I'm going to come over here. I'm going to click fill, which is on this over here in the editing series, and I'll make sure it's a row, and the step value is going to be 0.005 because we're going 0.5%. The stop value will be 0.13. All right, and it takes out there. Then we are going to come over now. We have the interest rates. Okay, and now I have the annual income. Now, if I want to make this look nicer, I can go ahead here. I'm going to click on row 32, and I'm going to insert a row, just so I can put this right here, interest rates. Okay, and then here I'll put annual net cash flow. So it's clear about what I'm dealing with. Okay. So here's what I'm going to do. I've got this done. Now I'm going to erase this, and we'll redo that. We'll do the fill series again. And I put $100,000. Okay. And then I'm going to come over here to the fill, and I'm going to do a series. I'm going to do column And the step value is going to be 10,000. 10, and then 3 more zeros. Make sure of that. And then the stop value is going to be 160,000. $160,000. I'll click OK, and there it is. Now I'm ready to use the data table function, and I apologize. My brain just didn't register in to go over to the what if analysis. So I'm going to highlight these cells. I'm going to start here from B34 from this cell that, and I'm going to highlight the whole table. All right, and then I'm going to click on data what if analysis, and I'm going to click data table, and we get the data table dialog box. Now the row input, okay, is going to be B10, which is the interest rate, and the column input is going to be B12, which is the income. Now I want to look at this for a minute and talk about it, okay? Here's what we're saying. The row input cell is B10. That's the interest rate, okay? Remember, this is the x-axis where my cursor's at. And then the column or the y-axis is of this table is the additional income. This is a lot like a multiplication, a sum table. We'll click OK, and there it is. Now, I'm going to click the first, I'm going to highlight the cells inside the table. But before I do that, I'm going to go ahead and where the interest rates are, I'm going to highlight those. I'm going to put a fill in there so I have a table. Okay, and the interest rates. And just to make it look nice, I'm going to come over here on the annual cash flows. All right. And I'm going to use a blue. Okay. And then I've got interest rates, and I'm going to bold that. Then the annual net cash flow is, and the interest rates, I want to make sure that's bold. Okay. So I've got the annual net cash flow, the interest rates, and that. Yeah, that's better. Now, I just aligned the text right. Now, I'm going to put my cursor inside. Well, before I do that, I'm going to check to see if my work is correct. How will I know? I'm going to look at this cell right here, and this is at 10% and $130,000 annually. And that's what we do, and we have 1.0699, 1.0699. Okay, now I'm going to highlight all these, and I'm going to, let's see, I want to decrease the decimal by 1. No, I want to leave it at 4 decimals. Let's do that. We're going to leave it at 4 decimals because it's just going to, it's statistic, that it just makes more sense to do that. Statistically, it's sounder to do it too. Now, if I want to make this data table look pretty, I can come along the bottom here. Okay, and I think what I'm going to do is go with one color for all the borders. And so I'm going to come over here and put a nice blue border at the bottom, and I'm going to change this to a blue. And then those rates, okay, and I'm going to do the same thing with the annual income. And I'm going to put a bottom border on that. And I'll put a thick box border up here. Okay, and then one over here. And then this profitability index, this hinge for the table, I'm going to set it off as green and bold it. So we see this hinge. Now, a sensitivity analysis says how, as I said before, how much is an outcome changed by changing one or more of the variables. And so in this case, for example, the profitability index, if we got $110,000 a year and the interest rate's 7% or the discount rate, that's our profitability index. If it's 110,000, here's the profitability index. So you can see we're looking at various rates of interest and various amounts of annual net cash flow. Now I'm going to do something. I'm going to put my cursor inside here, and I'm going to highlight these figures inside, okay, which are the various profitability indexes. Now I'm going to come over here to conditional formatting, and I'm going to use color scales going from green to red. And let's take a look at this for just a moment. Okay, these two things over here, these two, you can delete those and put no borders. And we're rid of them. And I could go ahead then and put a table on the end, but I don't need to. Now I want you to look at this, okay? Here's a case where we use conditional formatting, just like we would if we were looking at temperatures or rainfall or projected amounts of ice. And intuitively we know that the greener something is here, the higher it is. The higher. The redder it is, the lower. And we get, if we take the lowest interest rate, which is 7%, and we take the highest annual net cash flow, okay, we get this figure, this return of 1.4103. In other words, a 41% return. If we take the lowest net annual cash flow of 100,000 and we take the highest interest rate, our profitability index is 0.7822. Right now, as it stands, we're just about in the middle. Okay, and see if we can bold that. Any trouble? That's where we are right now, 106.99. And you can see the pattern. See those patterns? We have these kind of middle values. And so a data table is great, but you really need to also utilize conditional formatting to show people the range of values. So what this says is, first of all, the higher the interest rate, okay, the lower the annual cash flow needed for us to get a decent return. Or the higher the interest rate, well, the higher the interest rate, the more net cash flow we have to have. The lower the interest rate, okay, the less cash flow we have to have. And you can see that in the pattern there. And so that's why we call this sensitivity analysis, because it shows us, okay, the types of incomes we can get. Now, if we take our base figures, we can see at $130,000 a year, if we're at 7%, you can see our return there is 18% and flows all the way over to about a profitability index of 0.9696. Okay, so we're a little bit below it there. And again, if I have the highest annual net cash flow and the lowest interest rate, or what we call a capital hurdle rate or required rate of return, the better I get. But this is where we sit, somewhere in about the middle. in terms of the interest rate and the annual net cash flow. Now we're going to come up here and we're going to do a little bit more work, and I'm going to take the assumptions area, all right, and I'm going to put that in a nice blue, and I'll bold every dark blue, and I'm highlight these. And this is the title, so I want to go ahead and make it look pretty. And then this area in here, I'm going to come down and use all borders. Okay. And this gives us the total cash flow. And we can come down here and do all borders as well. All right. And if we want, we can make this table look nicer. We'll put a dark blue up here. Then down here, we'll put annual net cash flow. That row, we'll put a blue fill in. And we'll make those bold. Okay. And there we be. So we've used the data table. We've done the following things. We've used the series fill to put out those interest rates. Okay. And we understand about the fact that I put in a series. I decide, is it going to be arranged in rows, that is across, or in columns? What's the step value? Step value means is how much is it going to change? And what's the stop value? Okay, and we went from 7% to 13% with increments of 0.5%. Then we looked at using that same tool to do the annual net cash flow. Okay. Now I'm going to take the annual net cash flow and I'm going to turn it to dollars. Okay. And then I'm going to come up here on the interest rates. And I'm going to change those to percentages, and I'm going to increase the decimal. And that just makes it a little prettier. Okay? So we started with this project. This company was going to buy a piece of equipment. It's going to cost them $640,000. In fact, this stuff down here, okay, $640,000. And I'll do the profitability index. I will put that bold. Okay. Now, and I want to go ahead and I'm going to move those numbers in the middle. Now, I have a sunk cost here, just like I did with Badger Jams, and that is that to buy the machine, it's $640,000. I will get $130,000 in production savings or efficiency, and then at the end of 6 years, it's 1, 2, 3, 4, 5, 6. I'm going to sell it at salvage. In other words, it's salvage value or used value, $210,000. Now that salvage value, okay, is what I can sell it for. Okay, and then I'm looking at the annual net cash flow. And then we compute the total cash flow. We compute the NPV, net present value, and then we have the cost of the investment. Then we have the net present value of the investment and the profitability index. So I'm going to save this, and then something happens. Now, I want to talk to you for just a moment about the annual income from the investment, the NPV. NPV assumes that we're working with an annuity. An annuity is a fixed amount of money for a fixed amount of time at a fixed rate of interest. This is an annuity, okay? But in real life, okay, out in the real world, cash flows are uneven. In fact, they tend to be low at the start and build to a high point around 5 or 6 years, depending on the type of project it is, capital project. So the one thing that's not realistic here, okay, is these annual incomes from investment that we think we'll get, okay? But it's a piece of machinery, and we know what it will do, et cetera. So it's probably okay to do this. Now, let's say that I have an investment that's going to get me the following. And I'm going to show you about it. I think we have the XNPV in here. So I'm gonna try it. Let's say I have an investment that pays me $50,000, okay, and then $40,000, then $30,000, then $20,000. Now I'm gonna go ahead and use the comma thing to make them look pretty. All right. Now I'm going to do the NPV. Okay. And the rate will be, I'm going to assume the rate is on equities historically 8%. So I'm going to put 0.08. Okay. And the values, I'm going to get those 3 values. Okay. And it's going to give me the NPV of that money. Now this total and I'm going to make this period 1, period 2, period 3, period 4. Okay, and so it's a 4 years. I'll put these here in the middle, make it look nice. And I made 50,000, 40, 30, 20. And at the end of that, the total was 113,000. Okay. But in terms of net present value at 8% interest, which is 8% is historically what the stock market has performed at on the long run, at about 8%. Things like money markets, security treasuries and stuff run roughly about 2.5%. So I use the NPV. Now I'm going to see if I can use the XNPV, if I've got that. And I don't, I'll put in the rate. And what was that? Is it be 0.08? And the values, I'm going to grab those. Okay. And the dates. Okay. And I'm going to put these up here. And here we are. Okay. I think I want real dates up there, but let's see what I've got here. Using the XPV, well, I'm probably okay then. I want to do this right, so I'm going to kill this off for a minute. Instead of, I'm going to make this, let's stick with this, 2009. I'm going to do this. The dates would be 1/1/2009. And this would be 1/1/2010. And this would be 1/1/11. And this would be 1 dash 1 dash 2012. Let's make sure I've got dates. Okay. Okay. Now I'm ready to do the NPV. The NPV handles uneven cash flows. I wanted to see this. I wanted you to show you this, because this is again an example, but it's not that realistic, because out in the real world, you typically don't even do this. I'm going to reverse these. I'm going to make this 20,000, and we'll build our expertise, and this will be 30. Okay, and then we start to get a real learning curve going, and we've got 48,000. Okay, and then at the end of that, I'm doing about 65,000. Okay, and there we are. So we have 163,000 total. Now the NPV shows up as $130,119. We're going to do the XNPV, which equals XNPV, because we're dealing with uneven cash flows. All right, and I'm going to put the rate. Okay, will be 0.08. The values will be these. And then the dates will be above. And let's see what we got. Now, notice this, okay? There's a big difference. This is the NPV result, okay? And the XNPV. Now, I want you to understand this, because, you know, when you take your finance class, if you haven't already, and you take it with Dr. Reader, well, with anybody, you're going to work with annuities and looking at the future value of annuities versus the present value of an annuity, or the future value of a series of cash flows, uneven cash flows, or their present value. Okay? Now, here we have an annuity, and we computed its net present value. Okay? Here, we assumed uneven cash flows. And you say, okay, why would this be so much bigger than here? Okay, well, there's a reason. It takes into account these fluctuations, okay? It takes into account these fluctuations. Now, as an alternative, I could take each one of these divided by 1 plus the interest rate inside parentheses, and then the exponent for year 1, year 2, year 3, year 4. Okay, and you can go out and take a look at that and see that from a finance textbook, or go out and you can Google it. Okay, so I just wanted to show you the XNPV so you understood, you know, that there are two ways to calculate net present value based upon is it a variable cash flow like I have right here, or is it an annuity? Okay, now we assume also, and this is another complicating factor. For example, in this project, we assume that the interest rate would always be, and just to make this look nice, let's go ahead and I'm going to put some all borders there. Okay, and that one, I'm just going to get rid of that. I'm going to delete that border, just make it pretty, much better. Now, what if things change? In other words, what if the discount rate or the interest rate is different year to year? That's a whole nother kettle of fish, and you almost have to do it by hand. Okay, and let's look at this difference from this equals, this is the difference between future value and present value equal. Okay, I have my money. I invested $100, and at the end of the year, and I earn 10%. At the end of the year, I'll have $110. But let's do this. And instead of that, let's say, what will my $100 buy me, or what is it worth if the inflation rate's 10%? And I'm going to have about $91. Okay. So that's something you'll want to get a handle. Well, you'll run into finance if you haven't already, but you will. And you'll learn about the future value of an annuity, future value of future value of single payments, lump sums, and then opposition in the opposite mirror side of that mirror, net present value. Okay. Now the question for this company is it worth it for us to do this project? Well, let's look at it for a moment. The interest rate's 10%. Okay, that's our company interest rate. The profitability index is 1.0699, which is basically about a 7% return. So I would probably say, no, I don't want to do this because I'm not getting the return on my money that I expect to get. All right. If you put it like this, look at the net present value of the investment. I spent $640,000 to make $44,000. Now, if I had just taken the 640 and put it in and earned 10% a year, okay, well, you could do it yourself and figure out what I'd have. So I might want to say, well, I don't know if this is worthwhile. There's a couple of things I haven't included in this. This equipment that we buy would have depreciation, and we'd have to look at that. Depreciation is a non-cash expense, meaning we take into account the expense of using a machine. We wear the thing out, okay? And there are different ways that we do depreciation, and you'll find that out. And there are depreciation tables for certain class of assets, etc. So we've done a sensitivity analysis, so we could ask ourselves, okay, how does this change? Well, we can see the kind of change that we get and which factors are more important. Okay, well, we'd really have to take a look at that, and we could play around with, for our purposes, this is where we are. And we could say, okay, if the interest rate goes up 0.5%, we're down to 1.05. If we go down, we're up to 1.08. Okay, but look what happens between 120 and 130,000 versus 130 and 140,000. So we look inside these cells to make that comparison. But what it tells us is that in general, it tells us this. The lower the interest rate and the higher the cash flow, the higher the profitability index. Okay? The lower the cash flow and the higher the interest rate, the lower the profitability index. Okay? Well, folks, that's just about it. We've been on here for a while, and I do appreciate the 4 of you who stopped by, and I hope everybody else will take a look, especially on a little bit of help that I gave everybody for exam 1, part 2. Thank you so much, and I will see everybody. Today's Wednesday, so I'll be back over tomorrow, which is Thursday, for section A of 1123. Thanks you very much, and I'm going to stop the sharing. Now let's do this here. I'm going to save this, and I'm going to diminish it down, okay? And then I'm going to upload it to, and let's see if I can find that. Open that up for a minute, just see if that's the one. Yeah. And we'll open it. And it'll be up here, and that's XLSX case 11, and it's floating slowly but surely. And that's what you'll want to upload. All right. And you'll find it down here. And it would be XLSX6, pardon me, XLSX11. There's one that's a good one to use. Done. Or you could do. Let's see if it's supposed to have uploaded for me, and that's odd. Let me just pop up here for a minute and find Harmon. There it is. So I've got it uploaded for you, okay? All right, folks, thank you so much. I will stop the share and then end the recording, and I will be back over there tomorrow.